in terms of gold, we might be going higher in terms of a number, but gold's outperforming as it did last year. And these gold miners, these top tier gold miners are really got huge margins. They're the value stocks right now. And I just think, as I said earlier, the run to gold has begun and that the run will continue. As I said on another interview, the run to gold is a very light walk, and then it's a brisk walk, and then it's a light jog, then it's a full jog, then it's a slight run, then it's a run, and then it's a sprint. And that analogy is how it goes. And we're just getting into, I think, the brisk walk right now. Once we start into the jog, that's when I think the public starts to wake up.
Experts say the rush toward gold makes financial sense. The asset offers investors a hedge against uncertain stock performance, since gold prices often display a degree of independence from movements in equities markets. As the founder of the Morgan Report, DavidMorgan explains the Exter Pyramid, where high-risk derivatives sit at the top and gold at the base as the most secure asset. He predicts that gold and the dollar will rise in a liquidity crisis, driving demand for safe haven assets. This shift, he argues, has already begun with increasing central bank gold purchases. Between 2021 and 2024, the volume of gold acquired by central banks more than doubled, signaling a significant change in monetary policy. In response to growing economic uncertainties, central banks have been increasingly wary of the risks associated with holding large amounts of U.S. dollars, which have faced fluctuating values and geopolitical challenges. Diversifying through gold has gained momentum as a hedge against inflation, currency devaluation, and global instability. Based on fundamentals, Morgan asserts that the run to gold is underway and is fueled by central bank buying and smart money. He suggests a major equity pullback could further accelerate gold's rise. U.S. stocks have seen a disappointing performance so far this year, while gold prices have climbed to fresh record highs above $3,000 an ounce. But the performance spread between these two asset classes suggests a change in the months to come. Gold prices have soared 12% so far this year, while the S&P 500 has plummeted nearly 7%. Over that period, the Dow Jones Industrial Average dropped 2%, and the tech-heavy Nasdaq tumbled by 8.5%. While gold seems due for a correction, Morgan remains unsure of its duration, recalling the adage, "There's no fever like gold fever." He notes that billionaires like Warren Buffett have reduced exposure, and when measured in gold, the S&P 500 has been declining since 2000. Now, we present the clips of DavidMorgan's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I'm a big believer in the Exter Pyramid, which if your viewers don't know, they can look it up. It's EXTER. John Exter worked at the New York Federal Reserve, but he was a gold bug. And he talked about a liquidity squeeze or liquidity crisis. And the pyramid's an upside-down pyramid with the least likely investments that are really worth anything at the top of the pyramid, which is upside down. So the base is derivatives, the quadrillion or 2 quadrillion out there, counterparty risks that no one knows what they're worth. And then you come down to the tip of the pyramid, which is gold. I would put silver in there as well. He's gold only. And at the end of as the liquidity squeeze starts in earnest, both the gold and dollar go up at the same time. And that's why I think that the gold, I've said it well over a year ago, Peter, I said the run to gold has started. And people are, oh, what is he talking about, right? He's a gold bug. What does he know? And of course, we've seen the market go from, I don't know what, when I said that, probably 2,600 to over 3,000 now. And what I meant was the big money, the smart money's moving into gold. Central bank buying was huge over the last couple of years, and that continues, as you said. We could just see this thing continue, and why is that? Well, if we get a stock market pullback of enough magnitude that we see a shift in the allocation from equities into commodities, which I expect is taking place or beginning to take place, we could just keep marching forward, get those maybe 1 day or 2 day kind of downdrafts that look somewhat scary because a $50 move in gold isn't that big a percentage anymore. And then people get shaken out or say, oh, I'm going to wait. And the market just keeps going up. The best way to maintain a position in these type of markets, if you're in, follow it up with not a real tight stop, but a stop, and let the market decide for you when to get out. And I do that with my trading position. I'm in for the long haul for my core position. And if you're new and you're worried, you're an equity guy and most of your net worth is in equities and now it's starting to roll over, definitely buy some gold. You don't have to bet the farm. And what do? What I just said, you get in at 3,000, you put a stop at, you look at the chart, or you could just use a percentage. You could use 6, 7%. And then if it moves against you, you lost 6%. But if it keeps going up, just keep moving your stop up. And these markets can be overbought for a long time. And last statement, I'll give it back to you, Peter. And this is an old adage. You're probably old enough to have heard it, but there's no fever like gold fever. It could be equities are going down. My pension doesn't look good. I haven't saved enough. Gold's starting to move. Fear of missing out. We get even more momentum. I wouldn't rule that out. I'm not trying to talk out of both sides of my mouth. Technically, it looks like it's due for a correction. But is that 2 days, 2 months, or 2 years? I'm not sure. Yeah, I think it's a rising wedge. It's technically looks bad. A lot of the smart money always refer to Warren Buffett. I mean, Buffett's got a lot of cash on the side. A lot of your billionaire class are not out of the market, but lightened up considerably, noticeably. They've had to file with the SEC so that everyone becomes aware of it. And because of those facts, and the market's long in the tooth, and we've been in a distribution pattern. And I showed for my private work the true price of the stock market, and that's done versus gold, not versus the dollar. And that's one of the books back here called The Invisible Crash. So if you measure the stock market, the S&P 500 specifically in terms of gold, it peaked in the year 2000. And what we have is a huge, massive head and shoulders formation. And right now, the right shoulder, which is where we are in time and space right now, it's a right shoulder that's peaking out and rolling over. And I really believe that's the most accurate way to look at the future, technically. And it shows we're rolling over in the stock market. In terms of gold, we might be going higher in terms of a number, but gold's outperforming as it did last year. And these gold miners, these top tier gold miners are really got huge margins. They're the value stocks right now. And I just think, as I said earlier, the run to gold has begun and that the run will continue. As I said on another interview, the run to gold is a very light walk. And then it's a brisk walk. And then it's a light jog. Then it's a full jog. Then it's a slight run. Then it's a run. And then it's a sprint. And that analogy is how it goes. And we're just getting into, I think, the brisk walk right now. Once we start into the jog, that's when I think the public starts to wake up and says, you know what? I've got X amount in my 401k. I don't know what the equivalent in Britain is, but my retirement fund has this, and I'm all equities. And equities have gone down this amount. Gold's up 30% last year. Damn it, I'm going to get some of my retirement in the gold market. And it just takes that new momentum to start pushing it higher. So I'm still bullish. I really think gold's going to be much higher a year from now. But again, I don't like to get people too excited because it's like any market. It does move up and down.
In the interview, DavidMorgan highlights the ongoing silver deficit, noting that while supply shortages have historically had little impact on price, the growing industrial demand could change that. He suggests manufacturers may start stockpiling silver, potentially driving prices higher. According to the report, there has been a shortage of supply for silver for 4 years in a row, and 2025 will probably be the fifth. Deficits deplete above-ground inventory, and even while there is still plenty of inventory, investors hold a large portion of it and demand higher prices to encourage sales. Industrial demand for silver has reached record highs, driven by increasing usage in photovoltaic, solar panel applications, 5G technology, and automotive electronics. The report added that photovoltaic installations are expected to set another record in 2025, further boosting silver demand. Spot silver has demonstrated impressive performance in 2025, trading around $34.10 per ounce as of 18 March. This represents a significant year-to-date increase of approximately 14%, outpacing many other commodities and attracting increased attention from traders and investors alike. While the gold-silver ratio remains historically high, Morgan's expects it to decline, especially if gold becomes too expensive for average investors. Let's get back to the interview.
So let's look at the deficit. First of all, Peter's correct. We've had a deficit for the last 3 or 4 years, at least according to Metals Focus and the Silver Institute. But we had a major deficit in the silver price from 1990 to 2005 inclusive. For 15 years, we ate 1.5 billion ounces of above ground silver during that 15-year price of 15-year period, which averaged at 100 million ounces a year deficit. It wasn't that amount. That's the average. Right now, we're running about 200, 250 per year. But there's still a fair amount of above ground stockpiles that can be eaten into. The point I'm making is this, I haven't said it yet. During that 15-year period, the price was steady Eddie. Now, if that were taking place in oil or wheat or any other market on the futures exchange you can name, that kind of a year over year deficit would have gotten in the newspapers, would have gotten on the financial press, and the price would have gone up because the supply keeps going down year after year after year. In silver, it didn't make a difference. In fact, there's a paper out by, or it's a report, I should say, it's more than a paper, by the Silver Institute you can get for free if you go to, I think it's thesilverinstitute.org or silverinstitute.org. And you can read it, and it basically says what I just stated, that supply doesn't change the price. And it's like, wait a minute. This is against everything we learned in basic economics, but you can make that case. So coming back to what you asked me, some point it will. The price of silver, when the inventory started to reach equilibrium and start to build in the above ground inventory, is about 2006. So the inventory built from 2006, and it's as recently as 3 or 4 years ago continued to build. The price peaked in April, last day of April 2011. So you had 2005, 6, 7, 8, 9, 10. So you had like 5 or 6 years of inventory build, supplies increasing, and yet the price going up and up and up and up. So there's something wrong in the silver market. And I'll look in the eye and say, what is it? If you go back 25 years ago, 35% of the market was industrial. Now it's 60. And so, as I said, if it was wheat or if it was oil or whatever, and you had that deficit, it would change the price. Now that 60% is industrial and continuing to grow, I think it will. So I'm not trying to talk out of both sides of my mouth. I gave you nothing but fact. But things change. And since the industrial side has taken the lion's share of the market now, and maybe jewelry and silverware stay about the same, photography's been a non-issue for a decade, that we have a situation where, yeah, the deficit matters because the industry needs it. And they say, wait a minute, I got to buy and warehouse some because I want to lock in my price for the next year. I don't want that variable in my output on cost of goods sold. I'm going to buy silver now. So I really think you hit it. I think it's going to be different than what I outlined between 1990 and 2005, where it didn't make a difference. I think this time it could, especially when industry wakes up and Apple says, you know what, give us a 6-month supply, warehouse it for us. We need it. And then someone sees Apple do that, and Mitsubishi phones up their metals dealer and does the same thing. So I wouldn't rule it out. But it's fascinating to me that this market is really difficult to analyze. It's much different than any other commodity, even gold. I mean, gold, as you say, we know it's money. You can keep increasing the supply and it keeps going up in price because of economic conditions and devaluation of currencies worldwide. But silver really doesn't have that role anymore. So you got to ask yourself, well, what else is going on? I think you hit it. I think it's a combination of all those. I think it started with the tariffs. But then I think it's bled over into what we've discussed on your show, Peter, all these other factors that influence the price and the fact that it is needed more than ever in a high technological society. And then you put investment demand on top of it because we're seeing a rollover perhaps in the stock market and the real estate market, even perhaps the bond market. We're getting push up in interest rates and everyone's betting the other side. So it will get I believe it will get to a lower gold silver ratio. I mean, sitting above 80 now, it's rather ridiculous to my thinking, but I'm a silver bug. However, in the more likely occurrence that gold gets outpriced out of Main Street and only for Wall Streeters or their equivalent, then people will probably start moving in the silver market, which is what happened in the late 70s when gold started going above 500, 600. And it didn't last very long, but people said, oh my goodness, fear of missing out. We didn't use the FOMO in those days, but that's what it was. So the momentum shifted into silver because it was more affordable. I think we could see that again.
As recently as January, experts predicted that gold might reach the symbolically significant threshold of $3,000 an ounce by the end of the year. In reality, it only took until March 14th to hit that benchmark. It's continued to tick upward in the days since. With central banks accumulating gold at record levels and silver demand surging, could we be approaching a major revaluation of both metals in the near future? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.